Assalamualaikum warahmatullahi wabarakatuh. Hello everyone. My name is via Azzahra Rahmadita with student ID number 234111011. On this occasion, I will be presenting a topic that has been assigned in my course. The discussion will cover key concepts related to the subject matter, which are expected to enhance our understanding both in theory and in real-world application. I hope the explanation I deliver will be clear, understandable, and useful for all of us. Without further ado, let's begin the presentation. Okay, let's start from the first slide, which is the definition of financial reporting engineering. Financial reporting engineering or financial reporting engineering is the process of how financial reports are designed, arranged, and in some conditions can even be directed to produce a certain display of information according to the objectives of the party who prepared it. In accounting practice, the preparation of financial statements is actually regulated by applicable accounting standards. However, within these standards, companies still have flexibility in presenting information. This is where financial reporting engineering comes in, namely how management chooses a particular presentation method so that the financial reports appear more in line with their interests. Within reasonable limits and according to standards, this is still permissible. However, if used excessively or intentionally misleadingly, it can lead to information distortion. Therefore, this concept is closely related to accounting ethics, transparency, and the quality of the financial information produced. Next, on the second slide, we discuss the objectives and basic concepts of financial reporting engineering. The primary objective of financial reporting engineering is to present financial information in a way that influences the perceptions and decisions of users of the financial statements. These users can be investors, creditors, the government, or internal parties within the company. In practice, management has several options in preparing financial reports. For example, in choosing an accounting method. Determine accounting estimates, or regulate the timing of recognition of revenue and expenses. For example, a company may accelerate revenue recognition to make profits appear higher, or delay expense recognition to make financial performance appear better. Even though these actions may still be within the limits of accounting standards, there is still a risk that the information presented does not fully reflect the true economic conditions. Therefore, financial reporting engineering has two sides. On the one hand, it can be used legally for reporting efficiency, but on the other hand, it can also be a tool to manipulate perceptions if not properly monitored. On the third slide, we will look at the practical forms of financial reporting engineering. The first form is method selection. Accounting, for example the use of the FIFO or LIFO method in recording inventory, can affect the amount of reported profit. The second form is the timing of revenue recognition or revenue timing, namely when revenue is recorded in the financial statements. The third form is the manipulation of accounting estimates, such as asset depreciation or allowance for doubtful accounts, which are highly dependent on management assumptions. Next is account classification, which is how a transaction is categorized so that the financial report looks better. There is also the practice of using non-routine transactions to temporarily increase profits, as well as the practice of window dressing towards the end of the reporting period to make the financial condition look more attractive. In addition, in some cases there are also exploitation of loopholes in accounting standards or accounting loopholes that allow companies to organize reports without directly breaking the rules. All these forms show that financial reports are not always completely objective, because there is still room for interpretation in their preparation. In closing, we move on to the conclusion on the fourth slide. Financial reporting engineering is a process in preparing financial reports that allows for the arrangement or engineering of information presentation according to specific objectives. If carried out within the limits of applicable accounting standards, this practice is still acceptable. However, if it is misused, it can cause financial reports to not reflect actual conditions. This can certainly pose a risk to users of financial reports, especially investors and creditors who use this information as a basis for decision-making. Therefore, it is very important to have professional ethics in accounting, transparency in reporting, and strict supervision from auditors and regulators. Thus, financial reports can still function as reliable, relevant, and trustworthy information tools in economic decision-making. That concludes my presentation on today's topic. From the discussion, we can conclude that the material plays an important role in improving our understanding, both theoretically and practically. I hope this presentation can broaden our knowledge and be beneficial for our learning process. Thank you very much for your attention. Wassalamu alaikum warahmatullahi wabarakatuh.